Okay, good morning, everybody, and welcome to the 54th edition of the Coffee Microcaps Morning Meeting. My name is Mark Tobin. I'm the founder of Coffee Microcaps. We're just going to run through a couple of intro admin slides here, and then we're going to get straight into it with our first presenter. First of all, I'd like to acknowledge our sponsor for these events, Meriwether Capital, Luke Winchester, who some of you may know from Twitter and elsewhere. His new fund is starting next Monday, I believe. The 22nd is the launch date. And if you want to find out about his new ASX Microcap Fund, please reach out to Luke. Quick compliance and disclaimer slide. For anybody joining us for the first time this morning, the companies we generally have presenting on here are capped under 300 million, are in revenue and approaching cash flow break even, or indeed are already profitable. We don't have companies on from the resources or the biotech sectors normally. So we have what I call industrial microcaps, and that is basically a catch-all term for microcap industrial products businesses, microcap technology, microcap financial services, microcap consumer goods, consumer staples businesses. Structured this morning's webinar, we've got two companies presenting over the space of the next hour, broken down 30 minutes each into a 20-minute presentation, 10 minutes of Q&A. If you do have a question for our presenters, please type it in the Q&A box rather than the chat function. This makes it easier to moderate when we get to the Q&A. And please note the webinar is being recorded and will be posted on the Coffee Microcaps YouTube channel tomorrow morning. You can follow Coffee Microcaps. We've got Twitter, YouTube, LinkedIn, and I also write a weekly paid subscription newsletter where I profile one interesting ASX microcap stock every week, and you can find that on the Substack newsletter platform. Up first, we've got Danny Nadri, country manager from Shekel Brainweigh, and we're going to follow up Danny with I've got the wrong one in here. We've actually got Neale Joseph from the Sustainable Nutrition Group is going to be following Danny. Apologies there. And I'm going to stop sharing my screen now. And Danny, if you want to start sharing yours.
Right.
It's coming through now.
We get it right.
Yeah. And if you just want to flip to that full screen mode, Danny.
Right.
Yeah, there you go. Perfect.
How does it look? Do you hear me well?
Yeah, you're coming through loud and clear. Ready to go when you are.
Wonderful. Good morning, everyone. Mark, thank you for the opportunity to see you again and do this after 2 years of global pandemic, but it's a pleasure to be back here. For what we're going to spend is about 20 minutes together with the audience, giving a brief review for Shekel Brainweigh, and then there's some time for the questions, I guess. Shekel is listed on the ASX under the ticker SBW. Disclaimer. To some of you may know the business, to the one that don't, Shekel is really a business that sits on two pillars, two almost distinct businesses, which has commonality on the technology side. On the left-hand side, you see Shekel Scale. It's a pretty established business. It's been a while, and selling to a very blue chip client. GE Healthcare from the US is its largest client, single clients. But then you see Toshiba and Fujitsu, Data Logic recently, Diepel Nixdorf and others, selling predominantly to two market segments. One is the retail and the other one is the healthcare industry. And what we're selling is a weighing technology, a smart digital weighing that goes either as an OEM or as a device which is used in hospitals and nursing and others. On the right-hand side, what you see is our new venture, tech venture, almost a startup, if you will, only supported by an established business that we started about 4 years ago. And we took our core competency in sensor technology, in load cell, in understanding weighing, added artificial intelligence and machine learning capability to create an enabling technology, if you will, a smart shelf or a talking surface, if you will. We could take this smart shelf and put it everywhere we want in order to create an enabling technology for solutions that is used through the retail industry. We started commercializing solutions about 1.5 years ago, and today have a very strong collaboration with Hitachi, Power Level, Imbera, USD, and Intel, of course, which recognized the technology in the last 2 years as a leading technology. So really just two businesses. We're going to talk about financials later and revenue. You'll see the two differences, the two businesses really operating this way. I'm not sure how much people know, but just a brief review from a week ago that we released. So Shekel scale revenue has reached $15.2 million until the end of October. That's a 22% growth year on year. And what is more interesting is a very strong outlook for Q4. Open orders for Q4 up 144%. So what we see is that the market came back strongly after COVID, that the demand for the products of the scale division is actually growing. And we see this trend actually continuing. So when you look at the numbers in more details, 15.2 million US compared to 12.5 million in the similar period last year. And what's more strong, what looks much better is $6.8 million on the books today compared to 2.8 million in the previous year. So what we see is business comebacks on all segments of the business, retail and healthcare, and in all territories really. Although the US and Europe leading it. And there's also local sales in Israel. The company headquarters is in Israel, but both in export and service fees. What we see today is that clients are actually returning to us, some after actually being with us. And the other thing that is very important to understand that is that we're doing this even though there were some major changes in labor shortage and electronic components inability, logistics prices that are going higher. So there's a lot of moving parts that we're dealing with, and we still manage to get a higher revenue. And even a higher market share. So we think we're taking business from competitors because we're more efficient in the way we operate. A quick update on our second part of the business, this startup. We're very happy to say that we just received a first order of 67 hubs. This is the fridge that you see on the right-hand side, and it's a smart fridge that we introduced to the market. The first generation is called innovator. It's a really cool way of shopping, not your normal way of vending where you press a button and something falls and you basically buy one product. In our system, you basically present your payment system, a fridge door opens similar to the house. You take salads, you take fruits, you take dairy, you take a product, and you actually see them before you actually decide to purchase them. And once you like them, you just close the door and walk. That's the first order we received from Belgium, from Colruyt. 67 units, the additional 20 or so units, a bit more than 20 in the US in some selective clients that are checking on them right now. The division also sold additional 70 Innovendi, that is the first generation fridge in Israel. That's a part of an order of the 1,200 machines from Tnuva, an Israeli dairy company. These machines are sold in a model which is one-time sell and SaaS model. So we sell the machine for roughly 6,500 US a pop, and then a SaaS model kicks in for the data collection. And the data really is, we collect information about products as they move out of the machine in real time, and we inform this to the operator, and these operators are now much more efficient in the way they service this. I think I covered this part of the update. So a bit about the holistic view of Shekel retail for the new division, and what we want to do. We really want to bring data into the retail world in a way that will make their life more easier and more automated. What we see across the retail is the need to be more automated, whether it's a self-checkout, whether it's data management, whether it's the fact that I want to communicate with my clients and understand what they want. There's a serious demand for data in the retail industry. What we do is bring this data right from the source, from the shelf. So not from an invoice, not from what happened in your garage, in your back door. We want to know exactly how consumers shop and exactly what they take from the shelf, and even if they return something to the shelf. So the ability to offer different solution on a micro market the hubs, which is the new fridge, our autonomous stores, two of them in Paris this year, one that's going to open in Atlanta and one in Israel, and the smart card is our approach to the whole retail industry. And we want to bring different solutions to different places to do exactly this. A bit about the corporate overview and what we are. Like we said, we listed on the Australian Stock Exchange on end of 2018. Company has about 155 employees, operates across different jurisdictions and different markets. I'm talking to you from Sydney, where we have an office. The issued shares 153, the share price at 18.5 today. These are the main shareholders. Excel Partners is a fund from the US. Concepta is a group of management from Israel. Agriculture Cooperative is really a kibbutz, and the rest is floated. I think we talked about the numbers. Quickly about our board, Arik Shore has been the GM, the CEO of Nuva, which is a $2 billion US revenue a year company, very experienced and veteran in the retail industry. And the rest of the team includes different people from the US, from Israel, from Australia, that has a different skill set and really help the company moving forward. So like I said, who we are, we like to say we're a technology innovator startup underpinned by an established business, which really take our core competency in sensor technology coupled with our relationship with the big players of this industry. And what we added is the artificial intelligence, machine learning capabilities, smart mathematics to create an enabling technology that fits into a new solutions. I don't think we need to go too much in detail as to the market size of this. The retail industry is just huge. There's everything that we're going to do in this market is going to be a certain market share, a certain percentage. It's never going to be all of it, of course. And there are other companies that develop solutions, whether it's vision-based or camera-based. I'm sure you heard about Amazon Go and others, and they're using cameras. We believe that our solution, combining digital weighing with artificial intelligence, is far more cost-effective and much more accurate. I mean, in different competition that we had, there's no doubt that we reach 98, 99% accuracy compared to much fewer than this in vision and other systems. So what does the new venture, the new tech offer the world? It's like I said, we start with a talking shelf, a very basic technology component that allows us to do all the big things with it. And what we do is you know, we have a product-aware bay technology, basically the ability to tell retail anything that moves out of the shelves in real time. That helps them with inventory management, with overstocking and understocking, but it also helps them with shrinkage, things like stealing and matching whatever people are scanning into really understanding that they took the right product and they actually scanned the right product. Then we have these first products which are called the smart cooler. Innovendy was our first generation. Hubs, which is a corporation with Power Level in the US, and Imbera is our second generation, predominantly geared to the US and some in the European market. And our end game, which is the Capsule, full autonomous stores. All those, by full autonomous store, it's about 40 square meters. You just walk in after you showed your payment mechanism, you take whatever you want and you just walk. Two of these already exist in Paris with Casino Monoprix. And another one is opening in Israel this month, and another one before the end of the year in Atlanta. All of our products for the Retail Innovation Division are sold as a one-time sell plus SaaS. So once they're deployed, you get a SaaS model kicks in. That's our first autonomous store in Paris with Casino Monoprix. Like I said, it's 24/7. The second one is a bit bigger and it's a store within a store. It's good to see that this division is, although it's in early days of commercialization, and that commercial order of hubs is not included in the numbers. So by end of June 21, the division had a $380,000 US revenue compared to $300,000 or a bit short of $300,000 in all of 2020. So we already start to see the if you will, the growing numbers, and we're sure we're going to end this year in a record number for this division. Of course, we just delivered another 70 innovendi in Israel. So clearly, this is going to be a better year, a stronger year for this division. The good recognition from Intel to almost everything we do as a market-ready solution for innovendi hubs and the capsule is just phenomenal. This recognition from Intel to the technology and the strength of the technology. I invite all of you to read a white paper published by them just 2 months ago. So definitely we see acceleration of commercial activity in this new startup. Again, we don't need to go in too much details. I think we have a short time today and we're reaching towards the end, but the market is really strong, and what we see is demand on all categories of these new products: smart cooler, micro markets, autonomous small, and autonomous convenience. So almost every segment of the market, we see a need in the retail space for automation and for better engagement in data-driven solution, which is what we're doing. Highlighting on the SaaS model. So basically, everything we do on the retail innovation is we want to provide a component which starts from a very strong sensor. We add artificial intelligence and crunching a lot of data that comes from these sensors, and we actually combine few of them. And through mechanism of changing center of gravities, if you will, I'm not going to get too detailed, able to collect extremely accurate data. So we know if you took a Barilla pasta sauce or a different pasta sauce from the shelf. We know where you put it, you know, if you misplaced it. Once we do this, we sell this hardware, but then we start to collect SaaS model on a monthly basis. And that's a monthly fee that we charge for per shelf, per area, per fridge, whatever the client is using. There's a whole vision behind this, which is on a different level, which we like to call DAS, which is if I can collect data from a Woolies in Wollongong and in Parramatta and in the Northern Beaches and in Melbourne, and I can actually understand how people behave in different locations or why they consume a certain yogurt here and less in this place rather than the other. If I can aggregate data coming from a lot of places, then my ability to then input business intelligence, benchmarking, advice, you know, things like what Nielsen does and offer clients. But that data is based on the raw data, exactly from the shelf, exactly where the engagement happens with the client. That's where we see a big value for the future as well. We're not new to the retail space, so you'll see that we're already selling to Fujitsu, Datalogic, Toshiba. They in turn sell their self-checkout to anybody from Walmart, Carrefour, Walgreens, and many players. Not Woolies or Coles, unfortunately, but all these players around the world. That's our go-to-market when we think about the new retail innovation division with Intel, Hitachi, Power Level. And this is a real live solution. That's actually an office building in Israel. They took one innovendi, they took another one, they took another one. They're almost what drove us to think in terms of autonomous stores. So let's make 6 of them together and create one store. But that's how we see the engagement happening in office building, transport, hospitals, almost everywhere now. Actually, even residential. In Israel, there's big residential houses. Not to go too much into there, would like to give the example that we could separate between Coke to Fanta to Pepsi, even though it says 1.5 liter and maybe come from similar manufacturers. In a very high level of accuracy, we'll detect each of them separately. We talked about it. Our scale division, traditional, is doing really well this year, serving the healthcare industry, retail, industrial projects, and OEM. And doing really well on the numbers. Even this division is now investing in R&D, and we're going to announce a really fascinating solution called Fast Track that we're going to announce in NRF, the largest retail exhibition in New York, in January 2022. It's a really cool way of analyzing everything that you put on a self-checkout, even if it's 5 Apple Royal Gala in a plastic bag, will detect it immediately, make all the process with your self-checkout seamless almost, and a lot quicker than it is today, and much more friendly. And we won't allow you to put carrot if you took organic banana as well. So we will actually know if you took carrot and wrote organic bananas. I think we talk about the fact that we're present across territories, across the world, even here in Australia, which is really nice. Yeah, we think we skip it. The outlook for 21, but going into 22 in one word, growth. We see this across territories, solutions, almost every segment of the, actually every segment of the business is seeing better demand and stronger ability going into 2022. And if we grow this year about 30%, I think we're pretty confident about the future as well. So that's the last slide. I think why to invest in Shekel. It's I think there could be different reasons, but I like to think that we have a wonderful technology, an enabling technology patented, something that we bring that's going to be very hard for anybody to reach. It's a combination of hardware, software, algorithm, combination of a smart sensor with advanced mathematics. So it's very hard to reach. I think that's the leadership that had a business that was making money, few $1 million EBITDA a year, decided not to be complacent, put all this money back into this tech venture. And yes, we raised money, but at the same time, the owners put their own money into the same venture in strong belief. And the market that we serve, the retail industry, is just phenomenal in terms of its opportunity size-wise. Mark, I think I've reached the Q&A section, and I'm sorry for being a bit over time, but hopefully that's okay. Mark. Do we have Mark? Mark?
Hi, Danny, can you hear me now?
Yes, I can hear you now.
Okay, I'm just going to read out that question that was emailed in ahead of time. How much revenue does the innovation segment need to achieve to reach about break even? What are the key milestones among the company's roadmaps to the break even point?
Well, it's an interesting question. And I think that that it comes down to the strategy. And that's why it's very difficult to, not difficult, but it's important to understand. The scale division is profitable. It is at 3 million EBITDA at this point, and it will continue to grow and be profitable. The new venture, there's always a thing that you need to measure. Do I want to invest a lot more and get a lot more market share? Or do I want to bring it immediately to profitability? And we spent today about $3.5–4 million US in this venture in a year. There's about 15–20 people in this venture. So what would be the exact number depends on sale price and when there's going to be more SaaS or more. So it may be on few $1 million. It's not hard to reach. The question is, do we want to bootstrap the growth, or we want to continue to invest in this and be in more territories, sales more? And when we look at most tech ventures and how they grow, they just want to be much more present out there, serve a lot more clients and worry later about being profitable. It's a decision that the management and board will need to make as we grow. So we would actually prefer to grow through investing more and be present more in the market, serve more clients. But that's a good decision that the management will need to think of. We need to create the fund for it. I think I received the comment here on the chat.
Yeah, so we've got two questions that have come through.
We have one in a venue now in Sydney. I can't disclose the place, but it's a medical center and it's really cool. They really like it. Somehow in hospital, you think that there's going to be the best food in hospital. It seems that they have not a very healthy food in the cafeteria. I'm not saying it, but it's a really good way to serve healthy food and new food and to people who finish operation at 10 o'clock at night and need something to eat. So we have our first machine in Sydney. in the last few months, just as we all got out of the lockdown.
And then we've got two questions have come in from the audience. The first one, what patents does Shekel currently have on the new technology? And then a follow on to that, I'm not sure if this is for both divisions or just for the new technology division. Who are the main competitors in your space?
Yes. Some of the components of the technology is patented. If the people could see the sensor, then I don't know if they can see the sensor, but that's a type of a sensor, a load cell. All the sensors that measure the weight are patented, and they can be patented. They normally include, in this case, a very unique metals. This one is actually from the same metal as the Iron Dome, which is the Israeli anti-missile system. So it's really depend on the component. Some parts of it you don't want to patent. So the whole trade secret and the algorithm itself, the information that we know internally because we collected millions of data points, is not something that you want to actually disclose in any case. And I don't think it will be very easy to anybody to reach. Remember, Shekel has been around for a while. It's not easy to copy what we do. So frankly, we don't see a big problem in terms of protecting our IP. The combination of the hardware and software is very hard for anybody else to reach. And we're leading the pack in this respect for a long time now. So for the second part of the question, it's very good question in a sense that we see few players trying to develop in this field. And some go with cameras and computer vision, and some do RFID. And people do try to track products in shelves in different mechanisms. We think that what we bring to the market is the best solution in terms of cost effectiveness. We see Amazon Go as a solution that really drove the beginning of the thought about autonomous store. But when you think about it, 6 years down the road, they still have, I think, less than 30 stores around the world. We're talking about Amazon. Think about Woolies having 1,000 stores, I believe. So I think it's very hard for them to actually scale up a shop that costs millions of dollars, where our shop would cost 200 grand. So it's a kind of, I think that what we bring into the market is a lot more cost effective and scalable. That's what we see within half a year, 4 stores already on. And I think that that's a major advantage that Shekel has. Having said it, I don't think that one solution fits all. And it may be that a fusion of sensors and a fusion of technologies would participate in the future autonomous life. And whether it's going to be a camera combined with artificial intelligence, with weighing technology, it's possible that that clients will use a fusion of sensors and fusion of data point, and we will still be a good participant in this. But you got to remember, retail is never 100%. It's never one thing fits all, and it's good that there's going to be more players in this field, and it's good that more people will participate in this effort. It's a huge market.
And then another question, Danny, from me. In terms of supply chain issues, in terms of getting components and machines into locations, that 6.8 million on the scale business that you have for the order book, is there any major delays there in actually fulfilling those orders, given, I think you mentioned, crazy pricing we see now on logistics routes globally? I'm just wondering, is that going to be a hamper in just terms of converting that order book into actual bookable revenue?
Yes and yes. Yes, it is a big problem. Yes, it will have an impact on our revenue. It's a good thing that we got a bit ahead of time in terms of being ready for this. But even though we have a 6.8 on the books to be delivered before the end of the year, it may be that we won't reach it because of the supply chain issues and the shortage of electronics. You'll be amazed, even shortage of manpower sometimes. And the prices of the delivery is impacting cost. And we'll try to elevate some of the prices to clients. So yes, it is a challenge. At the same time, it's an opportunity. We know that some of the clients that are coming back to us or now chose us, again, is the quality of the product, which is faster and more accurate, but also the fact that we could deliver and others couldn't. So it's also an opportunity in this respect. The fact that all these tectonic shifts are happening in the prices of sales and of shipment. So if you're more efficient, if you're more accurate, if you take better decisions about your supply chain and about your inventory, it may actually be an opportunity, but it's absolutely a challenge.
Okay, Danny, we're going to leave it there because we're just up on time. And I know Neale is patiently standing by to join us as the second presenter. So Danny, if I could ask you to please stop sharing your screen, and then we will get Neale to start sharing his.
I apologize that I will need to depart at this point, but I thank you so much for the opportunity.
Okay, no problem, Danny. Thank you so much for joining us. And I would like to welcome Mr. Neale Joseph from the Sustainable Nutrition Group. TSN is the ticker, not as previously advertised, Rob Graham from Shekel Group. Apologies for that, an error in my slide deck. But Neale, ready to go when you are.
Can you see my screen?
We can, Neale. It's not in full screen mode, but I can see the cover slide of your presentation now and your disclaimer slide.
Okay, so I'll have to try and get it into full screen mode because
maybe if you download that PDF that you're looking at and then just open it up in Adobe rather than this preview mode.
Okay, just a moment. Just a moment. Let me go here. You're seeing all my emails, but that's lovely. 1 second.
Yeah, let's try it this way.
How's that?
Yeah, that's much better. It's pretty much full screen now, Neale.
Fantastic. Thank you very much, Mark, for inviting me today to present to Coffee Microcaps investors. Always good to follow such an interesting presentation as just given, but ours is obviously in a very different space. So today I plan to present the Sustainable Nutrition Group journey so far and our growth plans, as well as provide detail around an exciting announcement we made on Friday. So on October 20th, our shareholders approved a name change from Australian Primary Hemp to the Sustainable Nutrition Group. Sorry about that. The board felt it was important for our name to reflect our broader strategy and signal to the market that our future is bigger than hemp alone. Our new ASX ticker is TSN. Since launching our strategy, we've been solely focused on delivering it as we capture the growing consumer shift to plant-based and sustainable nutrition. Since mid-2020, we've grown the business by broadening our product distribution to over 3,000 stores, building brands, creating innovative and disruptive products, and growing our consumer engagement. Our brand portfolio is taking shape with a new corporate identity and contemporary brands in the markets in which we operate. We are completely focused on 3 verticals in human nutrition, pet nutrition, and health and wellness. These markets are large, in growth, and have clear paths to market. They are global and all benefit from the strong consumer tailwinds of the transition to plant-based sustainable food and nutrition. Our 3 brands are Mount Elephant, which is our disruptive value-added food brand, Field Day, which is our pet supplements and treats brand, and Australian Primary Hemp, which is our ingredients brand. Each brand has clear positioning, well understood target consumers and customers, and are gaining consumer and customer acceptance and repeat purchase as our business starts to mature. Mount Elephant has been ranged in Coles, Woolworths and 7-Eleven. These leading retailers are given access in over 2,000 doors nationally. We're in category review season at the moment, and we've had no products deleted, which we're very encouraged with. In this process, we've also presented range extensions in our existing categories, And we're also entering new categories such as oils, which is a $620 million category here in Australia, and spices, which is a $425 million category. And we're also extending in bakery and in health. We're the first to market with a hemp and oat milk. Woolworths and Coles range our products, and we're building on this to enter into the cafe market across the East Coast. There are 16,000 cafes in New South Wales, Victoria and Queensland, and we aim to be in about 3,000 of those initially and then grow forward from there. Field Day, our pet supplement brand, was launched in June 2021. The pet supplements category is the fastest growing category in the US pet market, but is nascent here in Australia. Our range is selling well in all pet retailers and e-tailers, and our plans are to dramatically extend our range, utilising unique technologies and sustainable ingredients. Our products are currently ranged in Petstock, Pet Barn, Pet Circle, My Pet Warehouse, My Best Friends and Pet Culture. So all the major retailers and e-tailers. Additionally, we're rolling out to over 1,300 independent retailers around the country. The rollout has been hampered in the short term by some COVID restrictions and store closures and some supply chain challenges for our customers, but these are now reducing. It'll pave the way for clear growth as we move forward. Last Friday, we announced our relationship with Australian Plant Proteins. APP has worked since 2015 with the CSIRO to develop unique technology for isolate and concentrate development. After assessing a number of options, we decided that partnering with them will facilitate a fast entry into the $10.3 billion global plant ingredients market. Our approach, we believe, is fast to market, limited or defined capital expenditure, and the outcomes are exclusive to the Sustainable Nutrition Group. We'll have unique products that are high in protein, no or low allergens, and are GMO free. This separates our products from soy, pea, and other plants, whilst retaining all of the other unique nutritional ingredients and benefits of hemp. Our protein concentrates and isolates will deliver between 88 and 92% protein, be soluble, tasteless, and pale in colour, making it available for the broadest ingredient usage in bakery, beverage, protein supplements, and general food manufacturing globally. We will play in approximately 78% of the plant-based nutrition market, and commercialization is scheduled for Q4 22. So the current market size is currently at 10.3 billion US, with its growth rates estimated to be 17.5 billion by 2027. So certainly some very significant growth that we'll be entering into. FY21 was a transformational year for our company, delivering strong revenue and margin growth, as well as broadening our distribution. This growth has continued in Q1 of this financial year. As mentioned earlier, distribution has grown strongly, and we expect this to continue as we roll out all our brands. And we have now set the platform for these channels to be fully maximised. Concurrently with this strategy, we've built an omni-channel plan, executing in retail, e-commerce, and e-tail sites. In addition, we're also accessing the health food market and are focusing on distribution into 1,800 stores nationally. Our online sales across our websites have transitioned from 100% ingredients back in Q1 FY21 to growth across all of our branded options, offering higher margin sales, and are growing strongly. And we expect this growth to continue and align with the consumer buying patterns. With our channels now established, we're now deepening and broadening our product ranges. Retailers and consumers are really receptive, and we're seeing incremental ranging across all three brands in all of our retailers. This will be one of the key drivers of revenue and margin growth as we move forward. Our e-commerce business, starting from a small base, is now delivering over 800 orders a quarter and is growing quickly. In addition to our own platforms, we're ranged in leading e-tailers such as Goodness Me, Flora and Fauna, and Nourish Life, and are capturing the new ways that consumers are shopping post-pandemic. Our Towards Better approach from an environmental and sustainability program is driving us to be sustainable in all aspects of our business. We've commenced a program to make us carbon neutral and have a significant number of initiatives across our business to achieve this. We see this across our ingredient sourcing, where we're focusing on sustainable sources and traceable sources. In packaging, moving to recyclable or compostable packaging. Manufacturing and logistics, working through water reduction, electricity reduction exercises, as well as freight maximisation. And agriculture, where hemp is already a carbon sink, but then there are other carbon emitters in the processing and transport, which we're working through to reduce our carbon footprint. So in summary, FY21 is when we built our foundations. In FY22 and 23, we will continue to execute our plans, driving accelerated product development, as I've outlined, entry into the US $10.3 billion high growth plant ingredients market, broadening our ranges and entering into new ones, and growing our e-commerce business, all underpinned by the strengthening tailwinds of the consumer move to plant-based sustainable nutrition. Thank you. Over to you, Mark, for any questions.
Thanks, Neale. I think I just want to quickly mention as well, just given the name change, that this is not Neale's first time presenting at Coffee Microcaps, but if anybody is looking for one of his previous presentations, it will be listed under the Australian primary hemp name rather than the Sustainable Nutrition Group that is now known as just, I just wanted to point that out quickly, given the recency of the change. A couple of questions from me, Neale, just to maybe get the ball rolling here. Our audience a little bit gun shy this morning. In terms of, you talked about category ranging season. I'm just wondering, have you seen a move by the retailers where, things like Mount Elephant are moving from, let's say, the specialty section of the store to actually just being on the shelf side by side with more traditional brands and the standard stuff you'll get from Nestle, Unilever, etc.? Or are they still thinking, no, this hemp and plant-based expansion, we still need to keep in specialty? They don't really see it as mainstream yet. I'm just wondering what's the feedback you've been getting since you've been talking to a lot of retailers recently?
So I think each retailer is taking their own approach. So if I look at the milk category as an example, which is a really big amount of space in any supermarket, the plant-based brands and the non-plant-based brands are sitting side by side. In Woolworths, where we have distribution, our products are in the mainstream bakery aisle, and they're up against some of those more traditional brands like Greens and White Wings. In Coles, we're in the health food section. So I think each retailer is taking their own approach. What we do see is that premium plant-based products are driving new consumers into those traditional segments, and because they're at slightly premium priced, they're actually adding value to each category. So there's a real understanding and adoption. There are a proliferation of new brands that are entering the market in most categories, but we're certainly seeing it moving more and more to mainstream.
Okay, great. Then a question on the international expansion you touched on in your presentation. In terms of, say, Mount Elephant and the pet food lines, is it just moving across the Tasman and testing the waters in New Zealand, or are you thinking we can take this range up into Asia or into the US or the EU? I just want to kind of get an idea of where you think those two brands can go internationally.
So international expansion is definitely on our agenda. We will naturally evolve to New Zealand, and the category reviews in the major retailers in New Zealand are early in the new year. So we're already well positioned there. We've done a lot of scoping work and market research into the international markets that we want to operate in. And we see our brand going, we think it'll be in pet, particularly through Asia, as the proliferation of pet ownership, similarly to Australia, has grown dramatically, and there's a real desire for premium pet products. And we think that both brands will be strong in the US and in Western Europe. But early days for that. We take a really structured approach here, and we're doing market research and planning to ensure that we enter in the most appropriate way. But yes, certainly international expansion is on our radar.
A question from the audience around the share register. Strategic shareholders that are looking to add value. I'm not sure if there's been a substantial shareholder notice that person is referring to of recent times, Neale.
So there's really been no major change in our shareholder base currently. In the capital raise we did beginning of this year in January, a number of shareholders who brought more than money to the register joined us, and we're working really closely with them in the operational sense. We would welcome shareholders to our business that could add value there, whether it's through relationships, whether it's in sourcing, or other opportunities. We'd always welcome that very strongly. But we have a pretty stable share register at the moment, which includes some strategic shareholders.
Okay, great. And a question I've been asking a lot, and I asked Danny when he was on, just on the supply chain issues you kind of alluded to as well. Where are the major pain points? Is it getting stuff around Australia, or is it more on the manufacturing side, not being able to get packaging, bottles, cartons, or is it kind of a mixture of all of the above? And is it more in the Mount Elephant side? Is it more on the ingredient side? I'm just trying to get a clearer understanding of like where the exact pain points are on those supply chain issues.
So it's a great question. I've been asked that quite a bit. I think that COVID has impacted different industries at different times, and it certainly is now having an impact on the food and ingredients business. I think there's a couple of elements where COVID's impacting us. One is if I think about our e-commerce business and the well-documented blocks in the supply chain that Australia Post has had, putting Victoria on and off delivery cycles from time to time. So it's really just slowed down our delivery to customers. So so we've gone from a 24-hour delivery cycle up to a 72-hour delivery cycle there. So that's certainly been one impact, but we've explained that clearly to our customers. We are seeing, as you mentioned earlier, increases in freight rates and freight availability, and that impacts us on our packaging supply a little bit. And there are some ingredients and ingredient supplies that it's impacted us on. But I guess the area that's impacting us most, interestingly, and we think this will be overcome quite quickly, is because of the lockdowns that have occurred in Victoria and other states, and the COVID spacing rules in many of our co-packers or suppliers. They actually haven't had the capacity to produce to our volume requirements. And so we've just had to plan a longer term to be able to overcome that. I'm hopeful that certainly the internal stuff within Australia will sort itself out in the next few months. In terms of the international stuff, I think we are in the same boat as everyone else and just working our way through that. So there are some impacts there.
And when you mentioned manufacturing there, we've got a couple of questions from the audience. I'm just going to break it into two. How many separate products are there in the total range currently? So if we take the pet range, the Mount Elephant range, if we add them together, maybe Neale, and just comment on how many you've got in total there.
Okay, so our pet range currently has 5 products in the market, and our Mount Elephant range has 16 products, but only 6 of those are in grocery, and the balance are online and in health food stores.
Okay. And then the second part, how does the company manufacture and distribute their products?
Okay, so we have a manufacturing facility in Geelong, just south of Melbourne, where we do most of our ingredients and our raw materials, and we have 5 co-packers around Victoria that have larger scale than we do, and give us great reliability and lower cost than doing it ourselves. So that's how our manufacturing works. We have centralized distribution, and we distribute from 2 points out to all of our customers.
And then key milestones then, as we kind of push through this, I guess, Christmas period into the new year, is the main thing we should be looking out for is, you know, new products coming to market, getting onto shelves, whether that be online or in physical stores, or is there something else you want to kind of highlight to people to be really on the lookout for in terms of TSN?
Well, I think the new products will form the first element of the growth they'll see in the short term. I think the commercialization of our hemp isolates and concentrates, and our ability to engage with some of the major food manufacturers around the world, and we've already in early discussions with key distributors here and internationally, to start to see that be commercialized is probably what we'll be looking for in the next half. And then just the ongoing growth of our online business as consumers are adopting more and more plant-based nutrition.
And in terms of that online business, have you got a goal internally of, you know, the sales mix that you'd kind of like to see across the 3 channels? So, you know, pure retail in terms of, you know, Coles, Woolworths, versus the online, and then, you know, throw into the mix the specialty guys on the, let's say, the pure health food shops as we would know them in the past. Are you targeting any specific mix, or are you just trying to satisfy demand where it presents itself?
We are targeting mix. However, in this fast growth ramp up phase, opportunities move at different paces, and so we will capture the opportunities that present themselves or that we have created through our business development efforts. If I think about what the ideal mix for us would be, it would probably be 65% retail and 35% ingredients. And within retail, I think by the nature of the scale of the 2 major retailers, I think they'll probably be strongly weighted to those 2 major retailers in the short term, and then it will build out over time as we get more independent retailers, particularly in pet and in health food. The online business, we're happy with its growth, but we know that there's significant upside there. What we're interestingly seeing, Mark, is really strong growth in the e-tail platforms that we supply, like Goodness Me, Nourish Life, and Flora and Fauna. They seem to be growing incredibly quickly as people are buying bigger baskets of product from them. So I think that's the type of mix that we'll see.
Okay, great. And then just broad strokes, if you can, GP margins, you know, roughly across the 3 divisions, what do you kind of hope to achieve? Obviously, as online grows, you know, the margin should grow because you're capturing a bit more of it. But in general terms today, if we think of Mount Elephant, the pet range, and the ingredients range, GPs across the 3 of them?
Well, we'd like to see, so as we've always said, the ingredients business is the lower margin business because it's high volume. And up until now, it's been relatively low value add, although with the isolates and concentrates, we would see significant improvement in margin in that part of the business. With the mix more towards value add and retail, we would like to see, I presented earlier that our gross margin for first quarter of FY21 was at 45% across the mix of the business. We'd like to be pushing up towards the 50% as a mix. Online is a higher margin. Pet, there are some higher margins depending on the individual products. We're very structured in our work with the supermarkets, and everyone who I speak to says, well, when they get their teeth into you, Neale, they're really going to squeeze you on margin. And they're certainly very clear on the margins they need in each of their categories. But we work very closely on our target cost of goods sold to maintain the margin profile that we want. So I think we'd like to see across the business that we'd be aiming for that 50% mark in the short term. And hopefully as scale continues to grow, we should see some benefits in costs and other elements that we'll be able to capture. And what we will do is we'll reinvest that incremental performance back into marketing and product development. So we create the virtuous cycle of growth.
Okay, great. Let me just check, Neale, have we got any further questions from the audience? I know we've got those ones. Doesn't look like it. Neale, we might just leave it there. I know we're finishing about 2 or 3 minutes early, but thank you for coming back in and joining us once again. And we'll definitely be on the lookout for announcements over the next couple of months, whether it's the CSIRO partnership and stuff that's going to flow from that, or from announcements regarding distribution agreements, international or otherwise.
Thank you very much, Mark. Really appreciate the opportunity.